Hello guys, welcome back to my video. Thank you for joining in once again. Today I want to talk about financial literacy and I have a lot in store for you. So stay tuned and get informed. So first of all, I want to define literacy. So literacy for me is basically being informed about something in general. So let's say you are when you say literate, the definition is usually the ability to read and write. Now, when you put a prefix or when we make a compound term and add literacy as part of the name, let's say it's business literacy, financial literacy, uh, it usually means being able to read and write in a certain context. So when you say financial literacy, you can read and write financial information, you can read and write about, you can understand finances when presented to you in as information in a paper, right? So um, today I just want to talk about financial literacy, and I think um, financial information sometimes it's very secluded to certain areas, and it might limit other people from being able to understand or have knowledge about this wonderful thing called finance and money in general. So, as I've said, literacy is basically being able to read and write and being able to interpret information in a certain context, in a certain field. So financial literacy would mean being able to interpret financial information. So another thing I want to talk about is finance as a self-development tool. So money and finances, when managed and stewarded, and when one has enough money, they can do a lot of things with it. They can self-develop. They can develop other people around them. They can develop interests that they already have. They can like work on things that they already love and develop them into fully fledged ambitions or fully fledged things of their own. So let's say you love arts, you love, I don't know, education, you love health, you love these wonderful things that are very important to society, justice, whatever it is. You can use finances to develop your ambitions, or you can use finances to develop your aspirations. Other thing I want to talk about is the business school bias. This is very interesting. You see, financial literacy and financial information can be very, very. Of course, there's a lot of podcasts, there's a lot of people talking about financial information, but generally, you usually find that these people are people who have either come from business school or are in business school or have had something to do with business school. So I think that's unfair. I think financial literacy is for everyone. Just it goes beyond people who have been into business school or people who have done business as a course. And I think everyone should have like the list. Financial literacy is not complex. Everyone should have like an understanding of finances at a core level so that they can be able to, do something for themselves using finances. They can be able to acquire finances. They can be able to develop themselves with finances. They can do something wonderful for themselves with finances, whether it's for them, for their family, uh, and all that. So another thing I want to talk about is empowerment. Um, in the modern economy, money has become a very powerful, uh, whether it's a means of exchange or a store of value. Its attributes have been more relevant over time, and particularly the attribute of means of exchange. Not everyone can produce something, so we need to have money to be able to consume things that people have produced, or to exchange value between us, or to exchange value between individuals. And that means some people are more empowered than others just because they have this tool more than others, and it might create uh, a disparity between others. Between people in a society, just based on their 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 availability of finances and money in their life. So we can talk about societal empowerment, women empowerment. We can talk about self-empowerment just using finances. So um, I think when people can work together, can hold hands or do something like collectively. So you can talk about social capital when people um, distribute and use capital socially. So things like chamas for women in Kenya or in African countries. So chama is basically a group of people coming together, mostly women, uh, contribute a pool of capital, and they use it for productive means. The returns they distribute among themselves. That's usually the way, but it's usually small scale. It's a representation of it's a very good representation of social capital, which when taken to very high levels, or when it's done in large scale, it can have very, very wonderful effects. Um, we can also talk about societal empowerment when people can find ways of empowering themselves by themselves just within their communities by investing or putting money into the ventures of their fellow comrades within the same locality, within the same community, and the productive, the produce or the value from that business when it deploys or it gets back value in terms of money. The money can be distributed to the people who contributed the capital. So I think financial literacy and when I'm talking about this, I'm also delving into subconscious. I'm delving into um, financial inclusion, or yeah, I'm generally talking about inclusion when people are able to be included um, into the financial space or into the finance ecosystem in a country, in a society, in a locality, in a geographical location. So, yeah, I think when people have financial literacy, even to the lowest, whatever level it is, as long as they have the basic financial literacy, they can be able to do wonderful things for themselves, including empowerment, they can do self empowerment or empowerment in general, mobility, social mobility. They can move up the ranks of society. Um, at their own pace, at their own liking, depending on how able uh, they are from their financial literacy. They can be productive members of society. A lot of things can happen from just an individual or a group of individuals or a society being financial literate or financially literate. Um, let's talk about financial instruments. This can seem like a complex term, but basically it means the various things people use uh, to build wealth from a personal finance perspective. The various things that people use to build wealth, various things people use to ensure financial security. People use to develop themselves personally and as, let's say, a family, as a society. Financial instruments. So you've heard of them. Maybe the term might seem very exotic, but you've probably heard of them. Bonds, stocks. When you talk about um, so bonds, stocks, um, investments, generally anything that people use to self-develop and financially on a financial context, not just out of the financial context, very financial context. Investing in businesses or having investments in various things, those are financial instruments. Insurance is one of the most interesting ones that ensures that any shock, whether it's health-wise, calamity, whether it's death, you are protected. You don't have to dig out of your pocket, or you don't have to go into your pocket to get large sums of money just to pay for things, because that generally, usually means that you might end into financial ruin. So yeah, so I've talked about insurance, stocks, bonds, um, and what else can we talk about? Insurance, stocks, bonds, and general investments, MMFs, SACCOs, whatever people use to deploy their money for value and wealth building. Those are financial instruments. Debt management. Debt management is a very interesting thing when it comes to financial literacy. So debt is a very interesting thing. Uh, we can talk about it in the perspective of the debt, the creditor, and the debtor. So the creditor is the person who gives the debt, the person who gives money to you, whether it's a bank, whether it's a SACCO, whether it's a personal loan from somebody. That's the creditor. So a critical component of debt is interest. You know, it's called the cost of capital, interest, whatever you call it. That's the most important component of it, because sometimes I believe this is a thing that people do a lot. When you're looking at debt, a debt agreement or a loan contract or whatever it is, when you're signing the contract or you're signing for the terms of the loan, when you're getting the loan, what people mostly look at is the face value of what they're receiving today, or they're looking at what they're receiving today in monetary terms. I'm borrowing, let's say, like it's 10,000, 1 million. That is what I owe. But in truth, you're not accounting for two things. You're not accounting for the time value of money, and you're not accounting for, yeah, basically you're not accounting for the time value of money. What I wanted to say are embedded in time value of money. Basically not accounting for time, and you're not accounting for interest. Time will generally make your the money you owe more expensive. Interest also will do that. So in the concept of time value of money, you know that generally money, uh, basically they say that in time value of money, money today is worth more than money in future. So that the money that you are giving up today for the future should give you something, or you should get the benefit of holding of money today, holding of using money today and having to use it in future, and that payment is called interest. So let's say the creditor is giving up, let's say if it's 1 million, you've borrowed the creditor 1 million, the bank, whatever it is, you've borrowed them 1 million, you want to use it today. Of course, for both of you guys, the money is more important today, but the creditor has to give up money today to get it in future. So the payment for that, for giving up money today, which is more valuable, to get it in future, is called interest. Now, the interest component is the most important component, and the interest and the time component are the most important components of a loan contract or a debt contract, because over time, debt, the compounding factor makes um, debt more expensive over time, and the longer the time, the more expensive that debt is. It's called future value. If you are able to do the calculation and get the future value of your loan, uh, doing using the future value formula, you'll actually see the cost, the full cost of your debt, the exact cost, including principal and interest payments. You'll be able to see how much your debt fully costs in the time and using the interest that you have. Debt is a very interesting component or an interesting thing when it comes to financial literacy, because most people take it, but very few understand the terms of the debt that you're taking. The very few understand what it is that they're getting into when they're getting into a loan contract, a loan agreement. So yeah, it's very important to understand how to just a basic understanding of time value of money and how to calculate um, how much a debt will cost you if you have to pay it for the duration that, or the term that you have agreed on in the contract, and for the interest, the percentage interest that you're taking. So one thing you'll let me talk a little bit about interest. One thing you'll always realize that the interest will always be the interest will always be um, because the data, not the data, the creditor is always looking for value. They're not going to take something that will make them bankrupt, so, or something that will not really give them value. So it will always be well above inflation. You know, inflation erodes the value of money over time. Over time. Now, because inflation erodes the value of money over time, or the purchasing power of money over time, the debtor will always make sure that the rate that they're giving you is well above inflation, so that when they're getting their money back in that time period, they're going to be sorted. They're going to be like, they're going to have their full money. They're going to have um, their money well above inflation. The value that they're going to get value that it won't be destroyed by inflation, basically. So Um, when you're looking at loan agreements, make sure you understand the time value of money, you understand the full cost of what you're getting into. Uh, if you're looking at trades, you can use 10% as a base rate. 10% is a very good base rate, whether it's for any money agreements. 10% is usually a good base rate. You're looking at an amount way higher than 10. That's a very expensive loan. An amount significantly lower than 10, that can be, you can consider that a good agreement. But also the time factor is a very important component. But remember, the creditor always will be looking at inflation. These are people who are very financially literate and very financially smart, so they understand how the money moves in the financial ecosystem and the economy. So, and probably these are people who understand economics. They'll understand how inflation rises and falls, and how how that affects interest rates. So, yeah, make sure you understand the time value of money, the interest component, and the time component of your loan agreement. Those are the most important components. Your principal, that's a very small part. Your principal is a thing you can put in your head. You can see that face value from the contract, but that's a very small part of it. That's a very small part of it. Over time, you realize that once you start paying once you, let's say, year one, you might not realize how expensive your loan is. But let's say your loan is 10 years, for 10 years long, do up to year five, you realize you realize exactly why interest and time are the most important components of your debt agreement or your loan agreement. That's about debt when it comes to financial literacy. It's one of the most important things when it comes to financial literacy. Make sure you understand debt. Make sure whether it's a mobile loan, whether it's a mortgage, whatever loan it is, all of them are the same. They use the same principle. It's about a creditor making sure they're getting value for their money in the future, as opposed to using the money today. That's why they put very good interest rates for themselves. They get like very good interest rates. And a very interesting component I learned about loans is that your risk profile. So basically, when let's say a creditor, let's say it's a bank, they're assessing your credit history, your credit score, or your credit yeah, let's say your credit history. They develop something called a risk profile. How risky are you when it comes to paying loans? So the higher your likelihood of defaulting on a loan, the more riskier you are. The less likely you are to default on a loan, the less riskier you are. So your risk profile determines the interest rates charged. So you can be two people going for a loan for the same, probably the same amount of like the same amount of a loan, but you have very different risk profiles. One person is more likely to pay it in full and within the time, or probably earlier. One person is not. Trust me, your interest payments, or your interest in your contracts, your interest and your time, but mostly the interest component. That's what reflect the risk profile of a customer. The interesting part is the higher your risk profile as a customer, the more likelihood, not the more likely, it's actually that's what will happen. If a bank determines that you are a risky individual when it comes to loans, but they still give you a loan, they'll charge you a higher interest than than a person who is less risky uh, as a debtor. So for two things, for one thing is a highly risky person. First of all, they're risky based on the fact that they're more likely to default, and that's why the bank charges a high interest, so that even if they end up not paying fully, for the time that they'll have paid, the bank will have covered a significant amount of their debt, and probably they'll by that time they will be way past their principal, because if you understand loan contracts, you understand the time duration or the duration of the loan. The principal will be paid up within a within a short time, or after, let's say, if it's a loan, um, if it's a loan of 5 years, right? By the time, I mean, a loan of 10 years, let's say a loan of 10 years, by the time you're 5 years in, you'll probably have you would have probably paid the principal way long ago. Um, let's talk about So yeah, your risk profile makes you get a higher loan, I mean a higher interest payments than another person. So if you're more risky, higher interest payments; less risky, higher interest payments. So I said it for two reasons. One, the bank wants to make sure it covers a good amount of its principal and extra in interest before you default. And the other reason is the opposite. The other person who is less risky, they want to make sure that because loaning, or the loaning business, is the bank's business, so they want more people to loan to. So if you're a good have a good risk profile, they want to be able to loan you money. They want to have good terms with you. They want to have they want you to feel comfortable borrowing with them, so they'll give you very very welcoming loan contracts, so very like very good contract, so that you can like keep on borrowing with them, or you can develop a relationship with them. When you want to finance things, you can use them. So yeah, I think I'll end there when it comes to debt management. I think that's a very important component of financial literacy, because you find that um, the lack of financial literacy, you see, ignorance is generally, first of all, ignorance is a welcome to exploitation and what can I say? Exploitation is the best word to explain it. When you're ignorant about something, you're more likely to be exploited when it comes to something. And the more important that thing is, so let's say when it comes to finances, when you're ignorant about finances, you and you need it like somewhere in your life. Finances are important in everyone's life, regardless of how literate you are or not. Ignorance in finances will generally make you exploitable, or will make you to be exploited. And yeah, so there's some good actors in the finance industry. There's some bad actors. They're all actors, and people need to make money. So if you're not aware, you will be exploited. So I think financial literacy is for everyone, and particularly debt management. You should be able to understand how to um, manage your debt, and always avoid going into debt just to buy things. You can use savings, you can use investments, you can use basically when you're talking about debt, usually go for debt when it comes to productive purposes. You have a business, you have done uh, some years of business, and you want to expand. Yeah, good to go for loans. Um, Go for them when they're cheaper, because there are times when they're more expensive than others, or there are times when they become more expensive than at other times. So rather than personal consumption, don't go for that for personal consumption. Doesn't matter how good your risk profile is, doesn't matter how good you are with managing money. Don't go for debt for consumption. Use debt for development. Use debt for building something that you are otherwise not able to finance out of your pocket, but you're very shrewd and astute to be able to make it happen. It's just that you don't have the money, or you need um, money quickly. Sometimes you might have the money, but you can't pull it that quickly from whatever it is. You have money packed in investments, you have money somewhere. You can't pull it that quickly as you need it, but opportunity comes very and goes very quickly. So you need to act on it quickly. So go for loans for that kind of thing. Productive, not consumptive. So yeah, with that, I'll end my piece on financial literacy. Stay literate. Everyone needs to be financially literate. Not everyone can afford to go to business school, but that does not mean you shouldn't be financially literate. Financial literacy is for everyone, regardless of whether you go to business school or not. And it's funny enough that sometimes people go to business school and are not financially literate. That's it's a bad thing. But yeah, and I also think, yeah, business school uh, puts the like you are at more advantage of having financial literacy, or being very financially literate when you go to business school, but it's not a guarantee. It's not a guarantee. um yeah, stay literate on matters finances. You don't need to know very complex things. You just need to know about debt, debt management, when and how to get debt, what are good terms, what are bad terms, um, what are financial instruments. Some of them you know them, maybe you don't know them as financial instruments, but you know them already. uh, what are what are uh, how can you use money? And I think money doesn't need to you don't need to have a lot of money to do something great. You see, money is about, I feel like being successful in the in this financial game, or in this game of finance or money, you just need to be productive. Put money somewhere, it brings more value than you put into it, or it has more value than the money you put into it, and then you reinvest that money, and you do that, and over time you'll be great, or you shall be able to do some great things. I forgot just to talk about business, but that's probably for another day. But business is one of the most wonderful ways uh, uh, um, to explore your abilities when it comes to finances. You don't need to own or have you don't need to have a business or make your business from scratch. You can always buy businesses. You can always put your money into businesses um, where you are non-active uh, partner. There's many ways you can participate in business than just building a business from scratch and selling it to, let's say, an investor, the way people talk about it. So yeah, with those remarks, I think everyone is ready to stay financially literate, and I'm sure you can find probably more information outside my what I've talked about. But my aim was to just talk about the essential stuff, the basic stuff, the things that everyone needs to know, regardless of the level of education or the level of exposure. So stay guided, stay literate. See you next time.